Let's get into the advisory now. We are getting closer to the start date, of course, for Division 296, the new financial year. How will this impact investment in startups and for younger people as well? John Vanderpoel from Morgans joins me. John, great to have you with us. Just take a step back and tell us, of course, what we're expecting when Division 296 comes in.
Yeah, so I think the really important point to remember here, it's still not legislated, so we're flying blind a little bit at the present point, but we do have some clarity around how the government sees this. So it's effectively, we're advising clients it's going to come into effect from the 1st of July 2025. There is some hope in the industry that the government may defer this until the 1st of July 2026 to help us out a little bit. But a couple of key points that I keep reminding clients about. It's not 15% tax on the excess fund above $3 million. It is going to be an exercise of looking through to the earnings and the tax to be applied on earnings. It also applies to each member account. So in the case of a couple who maybe has $5 million in a self-managed super fund, $2.5 million each, they will not be impacted by this Division 296. The industry, as you're well aware, has some real concerns about it, where we're concerned about taxing unrealised gains. It's something that we haven't seen here in Australia previously. And the no indexation really bugs me. I think younger Australians, they just get hammered from every angle. And that's part of the fight that the industry is taking on, really, to try and help young people out, because they will be caught at quite a level in time without indexation being applied.
All right, so what does that necessarily mean, that somebody younger is going to get affected because of the fact that this is kind of kicking it down the road in terms of the indexation for another government to deal with?
Yeah, so there's been some really good research and analysis done on this, looking at no indexation and making the assumption that a young Australian maximises their $30,000 concessional cap, which, just as a reminder to your viewers, that includes employer contributions, any salary sacrifice that an individual may do, as well as deductible contributions just to top it up to that cap. With no indexation, you're going to see in the order of 1 million young Australians over the next 20 to 25 years will be captured by this tax if no indexation is to apply. And I think it's safe to assume by the time that young Australians are retiring, government benefits such as the age pension may not be there, or it'll be a lot more limited, more difficult to get access to. So I really do feel for young Australians with what Division 296 is throwing up at them.
Do you think, John, that means then that people will stop engaging with superannuation, younger people, and maybe that could be to their detriment?
Yeah, and that's a really good question, and that's a great concern for the industry yet again. But the thing that I keep saying to clients in this conversation is, where does the government stop here? If they're going to go after, they're going to look at unrealised gains in the context of superannuation. If they manage to get that away, do they then look at family trusts, companies? Do they just look at us individually? Do they start to look at the family home, which is generally seen as sacrosanct in this conversation around capital gains tax? There's certainly a lot to be worried about. And going back to an earlier point, which I haven't addressed, just the startups. Australia is known as an innovative, entrepreneurial country. And one of the things that industry super funds, retail super funds, and also people through self-managed super funds do is invest in startups. If you're lucky enough to invest in a startup and it, goes up 10 times in value, this could be pretty heinous under this Division 296. You could find yourself being hit with a very large tax bill somewhere along the way because you took a risk and you were successful. But then by the time you actually go to exit that position, maybe it's decreased in value due to various issues, but you don't get the tax back that you've paid. It's tough luck, frankly, is what seems to be the approach of the government. So yeah, a lot of unintended consequences, which often happens with government policy.
But if we're looking in the here and now, would your advice, John, still be to people that maybe haven't met their caps as we head into the last few days of the financial year to top up, or what are you sort of seeing in terms of the best way forward here?
Yeah, certainly. So I've spent the last couple of weeks working pretty hard, just chasing up my clients on deductible contributions. Also looking at unused caps. So there was a change came through with the Turnbull government a couple of years ago with the ability to look back over the last 5 financial years. If your super balance, your total super balance is below $500,000 to catch up on those unused concessional contribution caps. That legislation has been really quite a positive one for females in particular with broken work patterns. And it's also proved useful for me with a couple of clients I've dealt with where they've enjoyed a capital gain event from the sale of maybe a rental property. And we've been able to, top up funds into superannuation to reduce their tax payable. That's one that just seems to get forgotten about, this catch-up mechanism. But as I said, most important proviso there, it's for total super balances below $500,000. And just the other thing, reminding clients about other ways that they can save, maybe reduce their tax payable. If you've got investment loans, look to prepay interest prior to 30 June, if that's an option, or you've got the cash flow to do so. And also just making certain you've got all of your tax records in place. When it comes to share portfolios, it might be crystallising some losses, and we're certainly seeing some decent levels of tax loss selling going on out there at the present time, just investments that haven't worked terribly well. People are cleaning those out to offset gains that they've enjoyed throughout the year.
One area people don't seem to be cleaning out, if we look more broadly at the market, is CBA continuing to hit these records. What are you looking at in terms of volatility and stocks to avoid or stocks to look at?
Yeah, look, CBA, we jokingly call it the widowmaker. It's just been a phenomenally successful share over the last little bit, and you're brave to actually back against it. To go against the trend at the moment. I talking to a client yesterday, and I said I'm sure it'll go above $200 a share over the next little bit. However, looking forward to the upcoming reporting season, I do have some reservations around Commonwealth Bank and what may happen. I think they'll report well. I have no reason to expect they won't. But when people look at it and go, I'm paying 30 to 35 times future earnings in a company that delivers no growth and is paying a franked up dividend of less than 3%, maybe we have to reassess this. And the danger there is if funds start to flow out of Commonwealth Bank, there'll probably be some contagion with that. I imagine people will look the same at the other banks, and we could see some really interesting developments during the upcoming reporting season.
Absolutely. But more broadly, is it still sort of looking amidst the uncertainty at things like gold as a hedge too, John?
Yeah, look, I love my gold stocks. I've been there for probably the best part of the last 18 months. Thank you. That's a great chart there. Part of the reason for my attraction to gold, and I really accelerated my buying in gold, was the election of Donald Trump. His policies were there for us all to see, and I just assumed there would be a fair share of volatility. So I have been putting more and more gold into clients' portfolios. I'm also encouraged by the central bank buying in gold that's been going on around the world, with, I think, governments concerned a lot about US debt and what might be happening there. So gold continues to be attractive, and everyone can see the price in US dollars per ounce every day. It just seems to be stuck around that 3,300 US an ounce price, which converts to about 5,000 an ounce Aussie at the present time. And I've got a couple of gold companies that I'm happy to discuss in a little bit more detail for your viewers. Of course, general advice. I haven't considered your circumstances, but happy to talk about a few that I'm actively following.
All right, maybe just give us one name and we can revisit this conversation another time and drill down into them, John.
Yeah, no problems at all. Look, play it nice and safe. Newmont, absolutely outstanding company. I mean, it's one of the biggest gold producers in the world. It's an S&P 500 company. They've got 14 key projects around the world, and people may know them well for they bought Newcrest, I think in 2023 now. Got it for a song in hindsight. But they've got 11 tier one assets, which they're operating, 3 tier one assets, which are not non-operated. This is a company that's just printing cash at the present time. And what are they doing with their money? They're buying back shares at a rate of knots, paying down debt, and they've started paying a dividend, 25 cents US a quarter. So yeah, really like it. I think it's a pretty safe one to put in your portfolio.